What is the character of our inflation? There's a zeitgeist. It's a one-off of oil down, inflation goes away. Anna Wong at Bloomberg says, maybe not. What do you think about the permanence of this inflation?
Yeah, that's really the debate right now. It's the debate in the bond market, to a lesser degree in the equity market, but certainly in the bond market. I think there are risks that it could spill over from these energy products, higher gas, oil, to the core, to inflation expectations. A risk. Our baseline is, though, once oil supplies and energy and commodities start moving, right, we get some resolution in the strait, that we will see inflation ease. It's just somewhat if it's an impacts the duration of everything, right? So it's dependent on the duration. The longer this continues, the more we could get the risk of a spillover. But for now, we don't really, that's not our base case. But we do think the Fed probably just stays on hold for the rest of this year.
Kathy, you mentioned duration, and I have to go there. Basically, from where I sit, you look, for example, in emerging markets, you look at corporates, which is, shorter duration than sovereigns, outperformer. I mean, you see every investor on the planet saying, I got to get short duration. I want floaters. I want a position in the front end. What will it take for investors to move out along the yield curve here in the U.S.?
Well, I guess a great question. It depends on, if you're talking institutional or retail. Some institutional investors like ourselves, insurance companies, we're fine going out on the curve. In fact, that, we're more long-term and we have to match our long-term liability. So higher yields, we'll welcome that, right? So, but I think for investors right now, it's really a trade-off also between the equity market. You continue to see the equity market riding high, and there's this fear of missing out. But at some point, 10-year yields, 4.5%, no risk, and 5% on 30-year. I mean, these are attractive rates now for the bond market.
So then I have to ask you this. We're seeing massive amount of investment grade credit issuance and EM. I think we're at all-time records on the sovereign side. I mean, cost fatigue, debt servicing burdens. I mean, spreads aren't even moving here. I mean, do you see any risk that some of these, of a crowding out, so to speak, for bond investors here, that a lot of these new issues are going to prevent them from, taking risk in other areas of the market?
So far it hasn't happened. I mean, it's, we had a little bit of widening, as during the conflict and concerns, a few months ago, a few weeks ago, and we've come right back in. We're near historic lows across the board, like you said, emerging market or developed. So right now there just seems to be this sensational appetite, even though the sovereigns you can get risk-free and get a pretty good yield, but you get to pick up even a little bit more on the corporates, and there seems to be this strong appetite. It's always hard to tell when the scales get tipped, but certainly it is an interesting time we're in right now.